Good morning, good afternoon, good evening, everyone. My name is Ali Dadbek-Healy. I'm an attorney with Foley & Lardner. We are a minute or so away from 9, so we're going to wait another minute or so to let more people log in and get settled before we start. So appreciate your patience for another minute or so. And some housekeeping as we're getting ready. There will be a link for the recording and the slides, so you will get that. It'll go out probably a few days or so after the presentation. So if you miss any part of the presentation, don't worry, you'll get a link. You'll be able to go and watch pieces of it or all of it, or go back to it as you like. It'll take a couple of days after this presentation to get it ready, but we will send it out to everyone who registered. Okay, we are at the hour. I'll give it another 30 seconds or so. We've got a number of people that have joined, but in case there's a few more, we'll give them a few more seconds to join. While we're waiting, if anyone does have questions, I'll try to save a good amount of time towards the end to answer any questions you might have. If there is a question that comes up during a particular subject, feel free to drop it in the chat. If it's something I can answer while I'm talking about that subject, I'll certainly try to do so. Otherwise, I may save it to the end. Okay. Well, why don't we get started? Those that join, again, if you join late, feel free to ask any questions in the chat, and we'll try to answer them towards the end of the presentation. But let's go ahead and get started. So welcome, everyone. Really glad to be able to talk to you today and talk about a topic that's near and dear to my heart about how to do venture capital financing. I'll give a little bit of an overview of myself, the firm. We'll go over the agenda, and then we'll jump right into it. So just a quick little disclosure, nothing that I'm saying today should be considered legal advice. I don't know your particular facts and circumstances. And as I'm sure you can appreciate, anytime a lawyer is providing advice, it very much depends upon the facts and circumstances. So this is very general information. It's at a very high level. It's more educational and not intended to be any sort of legal opinion or guidance. It's not intended to establish any sort of attorney-client relationship. If you have questions that are more fact-specific, please feel free to reach out to me. I'll include my email so you can reach out after the presentation, and happy to get on a one-on-one call or have some email exchange. So just to quickly go over the agenda, we'll talk a little bit of overview of venture capital financings. We'll talk about some structural considerations. What kind of documentation is really important as you're starting to prepare to do a VC financing? Some of the different financing options. I do cover safes and convertible notes. That's not really your sort of VC financing, but it's something that oftentimes companies will use beforehand, very early stage, before they get ready for VC financing. So we'll talk a little bit about that. We'll talk about valuation and dilution. And then we'll jump into where I want to spend most of the time is really talking about venture capital financing. It's providing an overview, what you need to get investment ready, how to prepare for closing, some of the issues that you should be aware of, including some of the terms you will oftentimes find even in the term sheet as you're negotiating a term sheet, but then certainly in the financing documents as well. And if we have time towards the end, I'll talk about some of the common pitfalls I've seen over the years and hopefully give you some ideas of where things can go wrong, where the pitfalls are, so you can avoid them as you're navigating your, hopefully if it's your first or even if it's a subsequent financing. A little bit about my background. So I'm Ali Dadbek-Healy. I'm an attorney with Foley & Lardner. I'm in our corporate group, and my practice is primarily focused on emerging growth and venture capital work. A lot of work with startups, both on the company side and on the investor side. But it's essentially everything from, as we like to say, garage to global or inception to liquidity. So very early stage formation, how to forming the company, getting everything ready with regard to the initial documentation, and then helping the company as it starts to grow and scale, go through various financings, all the way through an exit. I work primarily out of our San Francisco office, work with companies throughout the US and the world, a lot of companies coming cross-border into the US from overseas, as well as, homegrown companies here in the Bay Area and other parts of the US as well. Love working with entrepreneurs and founders and investors. There's just a ton of energy and great vibe that helps the ecosystem, great innovation, things that you all are doing, which is amazing, and it helps solve a lot of incredible problems that need solutions. So love working with founders, entrepreneurs, and investors. Here's a quick little quote. I oftentimes, you'll hear me talk about preparation being key to any successful venture. And I've had a number of quotes over the years, but I thought this one was rather apropos. Success is where preparation, opportunity meet. You can never be too prepared, in my view. And we'll give you some examples of that as we talk through the rest of the presentation. A little bit about Foley. So Foley & Lardner, it's an AmLaw 50 law firm. We are a full service firm. We provide everything from corporate, IP, tax, litigation, government regulations, you name it, employment. So there really isn't anything we don't do. And it's really nice being in the startup space, working in the corporate side, because I can pull together a lot of specialists in a lot of different areas that we need. And oftentimes those do come up on financings, especially where there are a lot of reps and warranties about all sorts of certain issues that may come up on the regulatory side, compliance side, and we need to bring in specialists to provide that kind of support. So definitely very good in the area for startups. But yeah, we focus on a lot of different areas. We have 1,100 attorneys, 25 offices across the US and internationally, and been around for quite a long time. We have 4 main focus areas as far as industries, and then a lot of sectors. These are the main industries. I'm not going to spend too much time on this, but this will all be available. And let me pause here to take a moment and talk about, there is a section in our website which you might find particularly helpful and valuable. It's called Foley Ignite. We'll drop a link in the chat so you can access it, but you'll see a lot of good information. We publish a lot of material. A lot of it is focused on the startup ecosystem. So we have good articles that come up from time to time that may be relevant. We also have some document generation on the Foley Ignite site too. Some typical forms we oftentimes see founders need that are easy to access and get copies of. But we also have a whole bunch of other materials too. There's a Startup Advisor video series that I started a few months back with one of my colleagues. And so we have a discussion, and they're short, they're very short, a couple minutes, but it takes different topics and puts it into a short little video that's easy to watch, and that's all available there too. So there should be a link in the chat for that. Okay. So let's start off, and I'm not going to spend too much time on this, but as you start to prepare for VC financing, you may have already jumped through this hoop and be ready. But oftentimes I find founders haven't set up their company yet. So just very high level, typically investors want to see a C corporation, and they want that C corporation to be formed in Delaware. Delaware, because that's where investors like the company set up. The laws are well written, understood. There's good case law. It's a good balance. There's a court in Delaware, the Chancery Court, that hears disputes. Very experienced bench that will hear your dispute. And so for a lot of other reasons, Delaware is a preeminent state in the U.S. for where to set up your company, especially if you're going to go out and get outside third-party, i.e. VC financing. They're going to most likely insist you set up in Delaware. Most of the publicly traded companies that are listed on U.S. stock exchanges are Delaware companies as well. C Corporation, again, this is primarily driven by the investor community. They don't want to invest in a pass-through like an S Corporation or a partnership or an LLC. They typically want to invest in a C Corp, and there's a lot of tax and other reasons for it. I'm not going to go into that here, other than that's their preferred type of entity. So if you're setting yourself up to do a VC financing, make it easy for the investors. Don't set something up that they don't like. You're just going to have to change it and go into that type of entity, and you're going to add more cost and time. So easy to do it right from the get-go. Talking a little bit about early documentation for founders and early personnel. So I'm talking about your early employees, your early consultants, your early advisors. The one thing that's super important is making sure you've got the right agreements in place. And I honestly can't tell you over the years how many times I've seen founders set up their companies. They're all excited about the business. They've got their business plan. They want to go out and get their investment in place, but they haven't taken the time to properly document what they need to document. One, because it's important to protect the company, but also because investors are going to be looking for this. And if they don't see it, it's going to raise red flags. So what I'm talking about here are, one, intellectual property assignments. So anyone who's going to be joining your company, whether founder, early employee, early consultant, or any consultant, employee, or advisor, if they're going to be doing anything that has any sort of value, IP attached to it, they're creating the technology, they're writing the code, they're building the machine, they're coming up with processes, they're doing the engineering, whatever it could be, even if it's just generating customer lists that are curated, meaning they spent a lot of time to generate the customer lists or to generate other lists, processes, procedures, all of that can be considered IP. It all could potentially be very valuable. You want to make sure the company owns all of that. And so there are agreements, fairly standard agreements that you will see. They're referred to as IP assignments or confidential information invention assignment agreements. That's the abbreviation CIIAA, or proprietary information invention assignment agreements, PIIAA. I know it's a mouthful, but both of those, this is the same thing. They're just synonyms. Super critical to make sure you have it, even with the founders, right? So I'll give you a reason why that's important. Two founders set up a company. They've both got ownership in the company. One of them is going to be the technical person that's developing technology, writing the code, whatever the case may be. And after a few months, that person decides to leave. But they've meanwhile developed the software that the company is going to use, but they never signed one of these agreements. Who actually owns that technology? Well, the co-founder that developed it owns it because they never transferred it over and assigned it to the company. They walk away after a few months. They take with them that technology because they own it. Now the company's in a bind because if you're going to try to grow the company around that technology, you don't own it. And the only way to get it is to go back to that co-founder and say, hey, by the way, you need to sign this over. It puts them in an amazingly leveraged position because they have no obligation unless there's some agreement that says they have to turn it over to the company. You might end up writing a pretty big check to get that back. Okay, so other topic that's important is if you're going to be granting any equity to founders, early personnel, again, I'm talking about employees, consultants, advisors, anyone who's going to get any equity in the company, there should be agreements that make sure that that equity is restricted, and that if the person ends up leaving or the relationship terminates, that there is the ability for either the options, if we're talking about options, that if they're not vested, they disappear. They don't get those. They don't get the right to exercise and purchase and get stock in the company if the relationship is terminated. On the other hand, if it's stock that was granted, and I'll go into a little more detail about the differences, then the company should have a right of repurchase on that stock, so that if the person leaves within a certain period of time, then the company can buy back that stock that hasn't vested at, usually it's at the same price that they paid for it, which is oftentimes little or nothing, because at the early inception of the company, there isn't much value, it doesn't have anything. And so let me take a little bit of time to explain the vesting, because it works differently for stock and options. So with regard to options, I'm sure everyone's familiar with them, because a lot of the public companies have options, and that's where a lot of people made a lot of money. They joined as an early employee, or they just kept getting options, and then there was some sort of event they were able to sell and make a lot of money. So the option is a right to purchase stock in the future. So you get an option today for 100 shares. I don't have any stock today. I have the right to purchase stock in the future once those options have vested. And the vesting is generally over a period of time. The typical period of time is 4 years, and oftentimes with a 1-year cliff, which means if I'm the employee that got the option, the 100 options, I have to work for an entire year. Once I've worked for an entire year, 25% of those options will vest, 25 option shares that I can actually purchase after that first year. And then thereafter, on a monthly basis, an equal amount will vest over the remaining 3 years, so that at the end of year 4, I will have vested in all 100 shares. So what that means practically, though, is if I left at month 6, then none of those options have vested. They all disappear. I don't have a right to purchase any equity. I walk away. I've got nothing. If I've worked a year, then I've got at least 25 that have vested. I could exercise and buy 25 shares. The rest of the 75 shares have not vested. They disappear. It's a way to protect the company. The last thing you want is for someone to get a bunch of options, in this case, have the ability to exercise them and buy shares, but they leave the company. They're no longer contributing to the success of the company. They're just there, and they can now exercise and have an ownership stake in the company, but not really be part of helping the company grow. On the flip side, and we're talking about actual stock, so same example, if I got stock today as an employee and I got 100 shares, it would be restricted stock. I get the stock today, so it's different than an option. I actually own the stock. I own whatever percentage 100 shares equals in the company, but the stock is restricted. There's a right to repurchase the company has. So if I leave, let's say in 6 months, the company can buy back all of those shares, all 100 shares, for the same price that I paid for them, typically peanuts. And it's typically the same vesting period of time, 4 years, 1 year cliff. So after the first year, the right of repurchase lapses over 25 shares. So I can now keep those 25 shares, but the remaining 75 shares the company can repurchase. So the vesting works conceptually the same way. It just logistically it works a little differently, whether you're talking about restricted shares or you're talking about options. So that's a critical piece. Investors will look for that. And if you don't have your shares restricted, or if you didn't set up your option plan properly, oftentimes investors will come in and say, yeah, you need to fix that. Transfer restrictions, we talked a little bit about that. I'm not going to go into too much more detail there. You just want to make sure as a company, you've got some restrictions. So you don't want someone that got stock in the company to be able to transfer it to a competitor, or somebody that you don't want to have an ownership stake in the company. Quick question, equity-wise, if a co-founder leaves, are you saying their equity disappears? No, I'm not saying their equity disappears. So again, it depends on whether they got options or whether they got stock. Typically with founders, they're getting stock. They're getting stock on day one once it's issued. They still have the stock, but if their relationship terminates, if they leave, the company has the right to repurchase whatever number of shares it has the right to repurchase. And it can buy those shares back. So they could leave depending on when they leave. The example I gave you was if it's the typical 4 year, 1 year cliff. If I worked for a year, I got 100 shares, they're restricted. Company's got a right to repurchase those 100 shares, but that right to repurchase lapses over time. So after the first year, the right to repurchase lapses as to 25% of the stock, i.e. 25 shares. So after year one, I leave, I walk away, I've got the right to keep the 25 shares I was given. The remaining 75 shares of the 100, the right to repurchase is still there. So the company could, if it wants to, exercise that and buy those 75 shares back. So it all depends on when you leave. If you have the right documentation, the right provisions, the company can buy back those shares that the right to repurchase still covers. Hopefully that explains it a little bit. I'll save the second question for a little bit later. Okay, so I'm gonna go through this a little quickly because I want to spend more time on the actual VC financing, which is different. If you're doing a convertible note or you're doing a SAFE, oftentimes early stage in the company, those two instruments, those two financing vehicles, if you want to call them that, are easier to implement. They're generally easier to prepare, less costly, less time needed. And so generally speaking, companies that are in the very early stages will oftentimes look to either doing a convertible note or SAFE if they're not ready to do a VC financing, i.e. they don't have enough traction, they don't have any revenues, or they're not further along, or they don't have enough technology developed, they don't have a prototype, they don't have proof of concept, they don't have what typically investors will be looking for. And I'll talk a little bit about what the investors are looking for in a little bit later. But the convertible note or the SAFE is a good way to get some early financing in through the door. And then, of course, the third one is the equity. That's the priced equity, which is or venture round, call it what you will. That's where you see the Series C, Series A, Series B, et cetera. That's where the VCs, if you're getting VC financing, will come in. They'll typically buy stock typically preferred stock with all the features, and we'll talk a little bit about that. That's your VC round. There's other financings I'm not going to talk about, grants, loans, etc. Not really in the scope of this presentation, but those are available too. Generally not all that realistic or viable for very early stage companies. Okay, so convertible securities, by its term, it means it converts. It's a security that converts into another type of security. Generally speaking, if we're talking about notes or safes, it's going to convert into an equity security at some sort of negotiated discount or some sort of price in a future financing. So what that means is if we're talking about, let's say, a convertible note, it's a loan, but it's got a feature in it that if the company does a financing where they're selling stock in the future and define that appropriately, then whatever you've invested as a loan in a convertible note, that will then convert into shares that are being sold in that future financing, in that next financing. They call it qualified equity financing, equity financing. But the point being is that the amount of investment via a note or a safe will convert into shares when the company issues or sells shares at that next equity financing. So the positives, it avoids valuation, easier to document, as I mentioned, less expensive. For notes anyway, it's a debt, so it's going to be on your financials. That's one of the downsides. The fix to that is to consider doing a safe, which we'll talk about in a moment. I'm going to skip through this a little bit. For convertible notes, there's a maturity date, typically interest rate, because it is considered a loan, so it has to have an interest rate. Typically has to have a maturity date. So those are all there, but most, if not all, investors putting money into the startup as a convertible note don't want to get paid back the principal and interest. They're looking to have that convert when you raise your first round. There's typically a conversion feature, as I mentioned. So there's an equation that'll be in the document that shows you what happens. How do you convert the investment into shares when they're the qualified financing? And there can typically be a discount, or there can be a price valuation cap with that. I have other programs I've done that I go into more detail on this, but I want to try to save as much time as we can for the actual VC financing. I can circle back to this if we have extra time towards the end. So talking about capitalization, and that's a good sort of segue into, as you're starting to prepare for a VC financing, you definitely want to be looking at and considering and be aware of the capitalization of the company. In the early stages, when you're setting up the company, important to understand how much equity are allocated, not only to the founders, but also to early employees, consultants, advisors. You want to start thinking about that as early as possible, because as people come into the company, and including between the co-founders, the more you give away, then obviously the more you're going to be diluted. If you're talking about, founder A brings in founder B, gives them 20, 30, 40%. Obviously, they've gotten diluted now. And then you hire a couple of early employees, or you bring in some consultants and give them some equity. That just further dilutes down the founders. So you just want to be tracking that and think about it from sort of a backwards perspective. So think about planning ahead for a year, 2 years, 3 years. How much ownership are you thinking of giving up now? What's the impact going to be on you as a founder, in 2 or 3 years, understanding that as you go through financings, obviously you're going to be diluted. And so you just want to be thinking about that. There's no way to fully calculate that out and figure out exactly what you're going to have, because it's totally unknown. You don't know what you're going to raise, how much you're going to raise, what the investors are going to want. But at least you can be planning for it and thinking about that, so you're not surprised one day. And where this really becomes important is when you start issuing convertible notes or safes. And I didn't really talk about safes much. I'll mention that in a minute. But essentially, it's a acronym for Simple Agreement for Future Equity. So it functions very similar to a convertible note, but it's not debt. It's not a loan. The investor puts money into the company under an agreement that basically says, at the next point in time when you do a qualified financing, which is defined in the agreement, then my investment will convert into shares that are being sold in that financing, either at the same price or maybe at a discount, but they'll convert into shares at the next financing. So what you need to be thinking about is if you've gone out and given a bunch of safes, you've given a bunch of convertible notes, you need to factor that into how that's going to dilute the founders when you then go and do your first equity financing. Because if those all convert, they're going to convert into shares, which means you're going to get diluted as the founder, but you're also going to get diluted from the investors in that priced equity round that are going to be investing and buying stocks. So you've got to factor both of those in. And I've seen situations where founders were eager to get money. They went out and raised a bunch of money using safes and convertible notes. They had a whole bunch of them out there, didn't realize how much they had. And then suddenly when they did their first price equity round and they all converted, the impact, the dilutive impact on the founders was pretty significant. Sometimes you can't help it. If you need the money, you need to get funds in the door to go ahead and build and grow. And those are the only terms you have. And sometimes that's what you're stuck with. But it's something to be important. It's something that's important to be thinking about. We talked about documentation, investing, repurchase rights. Talking a little bit about valuation and dilution. Just a couple of terms quickly. Pre-money valuation, that's the value of the company before the next round of investment. Post-money, value of the company before and after the investment. So the post-money valuation, a pre-money valuation plus the investment equals your post-money valuation. Issue and outstanding basis, basically what that means is who's actually owning stock today. So what's the ownership of the company today with those people that are actually, or entities that own stock in the company? What's been issued and is currently outstanding? Another way of looking at ownership is on a fully diluted basis, which basically means we're going to look at everything that's been issued that could convert into equity. And usually, this can be defined a little differently, but usually it means all the stock that's issued and outstanding, plus any securities that can be converted to common. So that usually is, if you've granted a bunch of options, remember an option is a right to purchase equity in the future. So they don't have shares today, they have it potentially in the future if they exercise and purchase it. Well, on a fully diluted basis, you just assume they've exercised and purchased all their option shares. So you factor that into the calculation. So now you're looking at a snapshot of the company ownership, assuming all of those convertible securities have been converted and shares have been issued. Now, what does the ownership look like? And obviously, the two oftentimes are different because when you factor in all of the convertible securities as if they were converted, the dilution on the founders is going to be, you'll see the dilution on the founders. So obviously, the ownership percentages will go down typically, depending on how much there is in convertible securities. Okay, so I'll go through I'm not going to spend too much time on this. This will be available on the slides. It's just important to understand some simple examples so that when you're thinking about it, it makes sense to you. And I'll talk about the one really quickly. So assume you have a pre-money valuation of $10 million. There's 10 million shares that have been issued amongst three founders, founder ABC. So they each have 33 and 3/3% ownership. If there is a $3 million investment that's made, and the investment is priced at $1 a share, right? Which I show you the calculation there and how you figure out what the price per share is. The pre-money valuation is 10 million. We talked about that. The post-money valuation is 13. That's the pre-money plus the amount of investment, 3 million. That gets you to 13. And you see the impact, the dilution on the founders is basically they'll end up with about 25%. They previously had 33%, but with the $3 million investment on those terms, it drops them down to 25%. Yeah, there's a typo. I'll fix that. It should be pre-money valuation plus the investment equals the post-money valuation. So thank you for pointing that out. I took what I just described and put it into sort of a spreadsheet so you can kind of see how that flows. I'm not going to go through it right now, but I've got a couple of examples. And then I have a couple of examples that show you how the convertible securities work. So whether it's a convertible note or it's a safe, if it's got a discount, how that impacts the number of shares they would get when that converts. And if it's got a valuation cap, how that impacts the number of shares they'll get when it converts into that next financing. Again, I'm going to try to save time. I can come back to this a little bit later, but I want to make sure we talk about the VC financing, the priced equity round, as opposed to these. But there's another spreadsheet I have up here that shows you the impact of a discount versus a valuation cap as well. Okay, so Overview of venture financing or venture capital financings. These are sort of highlighted or high level points, and we'll go into some of these. Number one is you've got to have a credible business plan. And it sounds common sense, but I can't tell you how many times I've seen founders put together a business plan that just is missing the mark pretty significantly because it is not at all what an investor wants to look at. There's a whole bunch of examples out there. If you spend some time Googling, talk to friends that have gone through and gotten financing, look at their business plans or their slide decks, if you want to call it, you'll get a good example of what sort of things the investors are looking for. They're looking for very specific criteria, but ultimately they want to know that you understand the market, you understand that there is a market fit for your technology, your product. You got to understand who your customers are going to be. You got to be able to show them that your company will be profitable and how long it'll take to get to profitability. And the most important piece of that is you have to be able to demonstrate how they're going to get a return on the investment. Basically by showing them, yeah, you're going to scale, you're going to grow with these projections, which need to be as accurate as you can make a projection. I know it's a guesstimate, but some people go crazy and say, yeah, the market's $1 billion and I'm going to be able to penetrate, 80% of the market in year 2. Maybe they could, but how realistic is that? But the point being is give them a way that they can see, okay, we understand the technology, we understand the market, we know there's a market fit, we think you can grow and scale. Where are we going to get our return on investment? What do we think this is going to net us out? Because investors, if you keep in mind, if you read the articles, it's either 1 out of 10 or 1 out of 15 startups hit it out of the ballpark, which means that one startup will generate the revenues for the funds that make up for all the other failures. Because there's a huge failure rate with startups. Hopefully not news to anyone who's a founder starting a business, but that's just the statistics. We go back decades. It's been pretty reliably demonstrated, a very high failure rate. So they're looking for how to make sure they get a return on investment. So definitely make sure you speak to that. Scalability, if you've got a company that is not going to be able to scale and grow and be able to demonstrate that revenues will increase, because that all ties into how do they get a return on investment, then that's going to be a problem, because they definitely want to make sure that the company is going to be one that can be scalable. That you understand the business financials. If you don't have a financial background, or if you don't understand the business finances and financials, take some time to study up, at least to become conversant enough so that if they ask questions, you understand the questions and can answer them. They oftentimes are looking for a team that they can believe in. So is there passion? Is there dedication? Is there a sense from the team that they're going to work hard, they're going to do everything they can to make this a successful venture, that they're excited about it? All common sense, but oftentimes people don't hit the mark there, and that can be a downturn or sour the relationship. Milestones are really important. Show the milestone. When are we going to hit milestone 1, milestone 2? What are those milestones? Getting to proof of concept, getting to prototype, getting to commercialization, getting to the first X number of customers, or the first amount of revenue that are coming in. And then perfect your pitch. You have a very, very short period of time to get their attention. And I always liken it to, if anyone has read or listened to any shows about screenplays, very, very hard to get a screenplay sold. You basically have to catch the producer's attention within the first 2 or 3 pages. And if they don't like what they're reading within that very short period of time, they're going to throw it aside. So very similar in that sense. You definitely have to get their attention. Run a systematic process. So I'll talk a little bit more about this, but essentially it's make sure you've got whatever capital you need, whether you're bootstrapping or you did the notes or the safes I talked about, you've got enough capital from whatever you raised earlier to be able to get you through your priced equity round. Sometimes it's hard to calculate, but I always say ask for more, try to get more than you think you'll need, because oftentimes things end up being more expensive than you can imagine. So have some cushion there. Connect with the right investors, take your time, really research and understand the investors you want to go after. It's not shooting a shotgun, it's really using a sniper rifle and looking at the right investor with the right background that's in your space, that understands the market, that understands the stage of your company. All of those are hugely important. Understand your ideal term sheet. We'll talk about term sheets in a bit, but basically that's the roadmap for the entire financing. And even though most of it is non-binding, once you've signed your term sheet, that's what you're going to be held to. Very hard, very difficult to change the terms once you've got a term sheet in place that an investor has signed. Because remember, they hold the checkbook. So even though the term sheet may have non-binding provisions, if you want to start changing and renegotiating and that potentially pisses them off, they just don't like the check. So we'll go through some of that in a few minutes. Make sure you prepare for thorough diligence. If you haven't been through that process before, you're going to be asked basically to turn over all the documents. They're going to be looking at them. They're looking to make sure that when they invest their money, there aren't any big red flags that can potentially jeopardize their investment. So, you know, are your documents in good order? Did you form the company properly? Are there any tax issues you haven't, paid or taken care of? Is there other liability out there that they haven't, they're not aware of or that, needs to be disclosed? And it can come up in a lot of different areas. One of them is, are you paying your employees properly? Do you have good documentation about your employees or consultants? If you're in a heavily regulated industry, are you complying with all those regulations? So if you're in the health tech, med tech space, or a healthcare, life sciences tech company, heavily regulated. If you're in fintech, heavily regulated. If you're in cannabis, heavily regulated. So make sure you understand those regulations. Make sure that you are in the place to be able to comply with them, because there will be those questions that are going to be asked, those reps and warranties you'll be asked to give, saying, yeah, I'm complying with all this stuff. Data privacy, data security is another one that's really important too. Have good corporate hygiene. And what I mean by that is kind of like what I just mentioned, is make sure your documents are well drafted, that you've got signed documents, dated documents, that they address the issues they need to address, you've saved them properly. It's all there. There's nothing that's missing, improperly done, etc. And if you haven't done things properly, then just be prepared. There'll probably be some cleanup items. Okay, so the term sheet, as I mentioned, is sort of the roadmap for the whole transaction when you're doing a VC financing. So I always tell clients and people I talk to is get as prepared as you possibly can before you even sit down to negotiate your term sheet. Because, imagine you want to balance out the negotiation, right? The investor is, if it's a seasoned investor, they've probably done hundreds and hundreds and hundreds of term sheets. So they know the terms, they understand it inside out. If you haven't done a whole bunch of these, if you're not a serial entrepreneur that's had a whole bunch of companies, then you're already at a disadvantage unless you either have a good attorney that does this kind of work that can guide you through the process, or you spend the time to do your homework and read up on this. Understand what dividends are, understand what liquidation preferences are, voting rights, protective provisions, because those are all typically going to be spelled out in the term sheet. And if you don't understand them and understand what's market and where the benefits are to having it one way versus another way, then you potentially could leave a bunch of money on the table or end up signing a term sheet that has some provisions that are not very favorable for you that you potentially could have gotten changed or negotiated differently had you been more aware or had you had your attorney with you at the term sheet stage to guide you. Some of the other things you'll see in a term sheet typically are conversion, anti-dilution, vesting for founders. So this comes back to what I talked about earlier. If your agreements don't have the proper vesting in them, even the founders' agreements, and the investor is looking at those, oftentimes they will say, okay, I understand it's been 4 years, founders, and you're fully vested now, but I'm not going to put my money in unless I know you're incentivized to stay with the company and make it successful. So we're going to revest some or all of your shares. And that may be a hard pill to swallow since you've already put in your time. But if you're dedicated to the success of the company and the investors want to make sure you're going to stick around, you may have to revest on your shares. What kind of documentation is going to be used? I'll talk about that in a moment. The attorney's fees, oftentimes the company will pay up to a certain amount of the attorney's fees for the investors' counsel. That's pretty typical. I know it sounds unfair because you're paying your own attorney and now you're going to have to pay the investor's attorney, but that's what they require. So no shop or confidentiality provisions. These are the two provisions that are usually the only provisions that are binding in a term sheet. Not always, but usually. And on the investor side, they typically want the no shop or exclusivity, as it's also called, because they don't want you shopping around. You know, if they're interested and they want to do a deal with you, they don't want you to take their terms and go shop around and try to get a better deal. It doesn't mean you can't have other investors invest with them if they're the lead investor. It just means you can't go and use another term sheet and start negotiating back and forth. And, you know, they've signed a term sheet with you, and then you go and shop it around, and then you do a different deal and go back and say, yeah, I'm not really interested in doing this deal. I got a better offer. Well, you signed the term sheet with investor one. If it has a no shop provision, you can't do that. Confidentiality, obviously good for the company. So if you're going to be disclosing stuff because they're going to be doing diligence, oftentimes even before they sign the term sheet, there'll be some diligence they're going to do. You want to make sure whatever you disclose is also covered under that confidentiality. And then, you know, other things, whether they're going to get a board seat or observer rights, something to be aware of as well. So I mentioned the term sheet's a roadmap for the transaction. The next piece will be the diligence process. We'll go into a little bit more detail on that in a minute or two. The documentation, there, 95+% of all VC financings are done using a set of model forms that were created by the National Venture Capital Association. The link is up here. You can go check them out. They have been vetted over the years. They've been drafted with input from the investment community, by legal community, by, you know, founders, entrepreneurs, and companies. So it has a lot of inputs, and it's been vetted over time. They're very well drafted. They are considered the market as far as some of the terms that are in there. And oftentimes that's going to be the starting point for vast majority of the financings that you'll see that are done as a VC financing transaction. There's another set of forms called Series C. These are a little bit more watered down, a little bit lighter in some of the reps and warranties, a little bit shorter, not nearly as popular. Don't see those very often. I would certainly start with the NVCA. And the reason why I mention it now is because even though oftentimes you're going to have your lawyers doing the work to prepare the documents or reviewing the documents, you should become, if you're the founder, or even if you're on management, you're going to be managing the transaction from the company side. Oftentimes the CEO, more often than not, the CFO is the one that gets the burden, the wonderful burden of dealing with all this. You want to make sure you're very familiar with those documents. So they're freely available. You can download them. They've got great annotations. They explain some of the provisions in good detail and footnotes, so you can go through and really understand, well, why is this provision here? What's important about this? And in some cases, they'll often tell you whether certain provisions are more favorable to the company or are more favorable to the investor. And that's important for you to understand. I mean, oftentimes the lawyers will do a lot of that negotiation back and forth, but it's always with the company or their client, whether it's the investor or the company, as part of the team. So, you know, we're communicating with our client, telling them, hey, the draft has these provisions. This is market, not market. Here's where I think we can revise or negotiate to get this versus that. But the more you understand it as the founder or entrepreneur or even the management team, the much better you'll be able to interact with your legal team, and it'll make it a much smoother process and much more efficient. The next step is basically the pre-closing. So what are all the things that need to be done and taken care of so that you can get to the next step or phase, which is the closing phase? So this, I'll talk a little bit more as well, but basically it's ensuring you've got all the proper documentation in order. If there are approvals that are needed, so you'll need the board approval, you'll need stockholder approval, but there may be other approvals you might need. So example, you may have raised some money using a convertible note, and the investor that gave you the funds on that convertible note included, as you're negotiating the documents, included a provision that says, hey, if you're going to go raise more than X number of dollars, then you need to come back to me and give me a right to also participate in that. Or, you know, or you need to give me the right to, you know, buy X% of the company, or you need to get my approval to do a financing. Those you need to know about, because those are requirements to make sure you've got all the consents, all the approvals, everything you need to make sure you can do the financing. Your investors are oftentimes going to be showing up and asking for that stuff too. So you don't want to be surprised for suddenly, you know, midway through the process, you're getting closer to closing. All of a sudden there's oh, wait a minute, we need to go to this one early investor we had done a deal with and get their consent. Never want to be in that position. So make sure you go through all of that earlier rather than later. And then the closing process is where all the documents have been finalized. You've got signatures in hand. You've got wire instructions. Everything's been done. All the approvals are there. You've got the board approving it. Stockholders have approved it. You've got your charter, your certificate of incorporation, your amended certificate of incorporation ready to file to create the shares that are going to be sold. Because oftentimes when you first form your company, you don't form it with preferred shares because you don't know what the investors are looking for. So it doesn't make sense to create it then. When you're first forming a company, that gets created as you're doing the financing. That's all done. You file what you need to file with the Delaware Secretary of State, and now you're ready to close. And so basically everything gets exchanged, signatures, wire gets initiated, and then you have your closing. And oftentimes there may be post-closing covenants. The investors may require you to put into place certain things. They're not important enough to do them before closing, but they're things the investors want to make sure you have in place after closing. And some of the things we've seen are, certain policies and procedures. So sometimes they want an anti-harassment policy. They want certain code of conduct policies. Sometimes they want that before, but usually it's not a big enough ticket item for them to say, yeah, we won't close without it. They just make sure there's a covenant in the agreement, stock purchase agreement, that you need to have that done within a certain period of time. And there's other stuff too. There's securities exemptions filings that need to be done, because when you sell a security, you need to make sure you get a proper exemption from it, so you're complying with securities laws, both on the federal side as well as the states that are involved. And giving notice to other shareholders who may not have approved the transaction, because you didn't need 100% of the shareholders to approve the transaction. At least under Delaware, if you don't get 100% of the stockholders to consent to the transaction, those that didn't consent have a right to get a notice of what was done. That's usually done post-closing as well. So here's again, overview of the financings, what kind of documentation is typically included. So I mentioned the NVCA forms. The NVCA forms fall into sort of five different types of agreements or documents. The first one is a certificate of incorporation. It's really a amended and restated certificate, because you've already formed your company. Now you're amending and restating to build in the new shares you're issuing to the VCs and the other investors. That's the certificate of incorporation. The stock purchase agreement is the agreement that is sort of the main governing agreement. That's the agreement that provides all the terms for the actual sale of the securities, sale of the preferred stock to the investors. Super critical, that's the agreement that provides for the terms, provides for the price. It also has a very long section, the representations and warranties. And that's where, on the company side, founders, C-suite, executives, whoever is managing or involved in the transaction needs to really understand all those reps and warranties, because part of the process will be, as you're going through the financing, is to read all the reps and warranties, make sure they're 100% accurate. And then if there's anything that's not accurate, you need to disclose that. Oftentimes the way that's done is you disclose it on what's called a disclosure schedule. So basically you have the agreement you're reading, the reps and warranties, you have a disclosure schedule you start reading that says, okay, with regard to, let's say the rep talks about you are validly formed in Delaware and every other state where you do business. And let's say your business is based in California, but you haven't taken the time to actually qualify and register your Delaware Corp in California. That's a disclosure item, because the representation says you've done all that and you're in compliance and you're properly qualified in every state that you're required to be qualified in, but you're not, because you haven't. So on the disclosure schedule, you would include a note to say that, the company has not yet qualified in California. And then of course, if it's something that can be done, you need to correct it. So oftentimes then there's a sort of a scramble to make sure you get that stuff done so that it's not going to be a problem. Sometimes investors will close without that. That's a relatively minor, less critical issue. But all of that stuff goes on your disclosure schedule. The investors are going to look at that and they may have questions. They may want to dig into stuff a little bit more. Another example of where that shows up is there'll be a no litigation rep that basically says there's no litigation against the company or any litigation that could potentially impact the financing. If you've got let's say an employee who was terminated a month ago, filed a lawsuit or filed a claim with the Labor Commission saying they weren't paid properly, that's something you're gonna have to disclose, because you can't make that rep to say we have no litigation if you know that someone has actually filed a lawsuit. So that gets disclosed. You write a very short narrative description of it. You need to work with your attorneys, because some of this stuff you need to be very careful with how you disclose it. If there's active litigation, anything you disclose on a document like that is discoverable. So you want to make sure you're talking to your attorneys. But that's the sort of stuff, and there's a whole bunch of other examples where you need to very carefully go through the reps and warranties and make sure you prepare your disclosure schedule. And that's usually something done hand in hand with your lawyer to make sure that you're getting the right information, you're disclosing what needs to be disclosed, and you're disclosing it in the proper format. The next agreement is the investor rights agreement. There's a bunch of rights that the investors want to have as part of that agreement. Another agreement called the right of first refusal and post-sale agreement. Again, there's a bunch of rights that oftentimes investors are going to want to see. A right of first refusal. So if the company goes and issues, if you're going to issue new securities, there'll be a provision in these agreements that talk about whether the investors are going to have a right to participate. If the key holders, which is a term that really refers to some of the important folks, oftentimes the founders, could be some of the very early sort of C-suite folks. But if they want to sell their shares in a company, that's a big concern for the investors, right? Because if they're the key people in the company, anytime a key person wants to sell their shares in the company, it could be a fairly significant percentage. They want to make sure they've got some protections. And so maybe it could be a right to purchase those shares. They have to be offered to the company first. And then if the company doesn't decide not to purchase them, then the investors can purchase them. So those are some of the other types of rights you might find in those agreements. And then the last of those, of the five set of documents, is the voting agreement. And that's oftentimes where you'll see how voting is going to be handled. There'll be certain provisions that are baked into the certificate of incorporation, but the voting agreement sometimes goes into a little more detail about who's going to get a board seat, how is that going to work, who designates the board member for a particular investor, things of that nature. Ancillary documents, those are all the other documents you need to have in place in order for the financing to be done properly. I mentioned earlier, you need the board consent. The board has to approve of financing. The stockholders have to also approve. And there may be other consents, as I mentioned. If you've had an earlier investor that had negotiated some provision that says you need their consent, or you need to first offer a certain amount to them, or you need to give them notice, those could all be provisions that you need to make sure you're aware of, so you can go and get those consents. The other one I didn't mention, but is important as well, it doesn't come up very often for early stage companies, because oftentimes they don't have the ability to get a loan. But if the company has a loan, oftentimes lenders, your typical institutional lender like a bank, their agreement is going to have a whole bunch of covenants, affirmative covenants, negative covenants, but things that they're going to want. And they certainly want to, in some cases, know if you're going to be doing the financing, and you may have to get their consent. So that's another example of where you want to know about that early on. Dealing with banks and getting consents can take a long time, so you need to start that process very early, because in some cases it can take weeks and weeks to get their consent. And you don't want that to be something that's holding up your deal. Everything else is done, and you're waiting for the bank to get back to provide its consent. Side letters, that could be the agreement I was referring to with an earlier investor. In a VC financing, oftentimes the investors, if they're VC investors, institutional investors, they may require a side letter, sometimes called a management rights letter. Sometimes it's different, but they may need to have certain provisions in there, or want certain provisions that they don't want to have put into the stock purchase agreement or one of the other agreements, but they want to have that specifically for them as the investor with the company. So I'll give you an example. So in some cases, they may want to have a very special right to purchase a certain percentage of the next financing. So not a pro rata right where they can keep their same percentage, but let's say they're a big lead investor, they're committed to this, they want to make sure they've got a certain, in addition to a certain percentage, but they can also take a much larger percentage in the next financing round. So they may say, hey, look, we want a side letter that says we have the right to purchase up to 40% of your next financing. So up 40% of the entire next round, they would have the right to purchase. So you're doing your next round, you got to go to them and say, hey, you've got this right, you can buy up to 40%. The other investors in the next round may not like that. So in some cases, you may go back and either get their consent of the prior investor to take a lesser amount, or maybe to waive that so they don't exercise it to get their 40%. But the import here is that you may need to go back to certain parties to get either provide notice or get their consent. And you never want to be in a position where you're stuck because you can't get the finance closed. If you're talking about side letters for that particular financing, that's just part of the process. You'll negotiate those, have your attorneys involved. Some of the asks I've seen are pretty outrageous and not market. Some of them are very typical, nothing you really want to be fighting about. But that's where an attorney that understands the space and understands what's market can kind of help and guide you. It can be really invaluable. Okay. So talking a little bit and diving into the weeds a bit on diligence. I talked about it sort of throughout, but it certainly merits taking a bit of time because it's a really important process. If you're not properly prepared and you haven't covered all the issues and done whatever cleanup you can, it makes the diligence process oftentimes a lot longer, oftentimes can raise questions for the investor. And in some cases, I've seen deals totally, fail because there were so many problems. The investor finally said, you know what, I'm not interested in investing. They haven't cleaned up the mess that they created, and I'm not going to stick around and wait for them. It's going to take too long. Or it shows them that the company is so messy and sloppy and doesn't pay attention to details. And if they do that with their corporate documents and other agreements and things, I don't really have a confidence they're going to be able to manage the business going forward. I'm not interested. You don't ever want to be in that position. So making sure you've got a good process, you're looking at the documents you have, the agreements you have, the corporate records are clean, you have a cap table that's properly, documented. You can back up everything that's on your cap table. Making sure you've reviewed the reps and warranties from the stock purchase agreement. Download the model forms now, so you understand what's going to be asked of you, so you're not surprised and then you're scrambling. I've seen that happen quite a few times. Start your disclosure process early on. Know your agreements. So if you've got a whole bunch of agreements, it's helpful to go through them. I mean, on the legal side, oftentimes we do that, but there's a benefit to having the company also be fully aware of the agreements that they've signed, because typically the founders will know the company better than anyone else, and they may remember things. Oh yeah, we signed this agreement 3 years ago. Yeah, it wasn't in our data room, but I negotiated it, so here it is, and here are the terms. The communication piece is super critical of your attorneys, because we're not there, we're not in the company, so we're relying on the information we get from the company. If we're on the investor side, then we're asking the hard questions about, well, you said you have this, but where's the agreement? And then you send the agreement, and the agreement's not signed. Well, why isn't it signed? And if it's an agreement that's critical because that agreement accounts for 30% of the revenue of the company, and it's not signed, and you don't have a signed agreement, that means that customer can walk away anytime and there's no repercussions. I mean, potentially, you could have an agreement that's by course of dealing could be enforceable, but you never want to be in that position. You really want clean documentation. The cap table tie-out is what we typically refer to it. All that means is whatever the cap table is, you want to be able to look at every single line item. So every person that owns anything, whether it's securities, convertible note, a safe, options, what have you, that you can drill down into that and go and actually find the document that supports that stockholder or that investor's piece on the cap table, and it's signed, it's dated, and it's accounted for. Because the investors are going to definitely, that's a really high value item on the diligence side from the investor's perspective. So they'll definitely be doing a cap table tie-out, and they want to make sure that you can support all of the people and entities that are on the cap table. Know what consents and approvals are needed. We already talked about that. And then disclosure, know what to disclose. And this is really where it's important, because your attorneys can be really helpful. There are some things that either are so trivial that it's not really material enough to disclose. So let's say, for example, you had a very minor contract dispute, but the amount in dispute's a couple $1,000. Well, if you're going out and you've got a term sheet for $10 million, I don't think any investor is really going to care about a couple $100 dispute. If it's really limited to that, then that's something that, again, talk to your lawyers. They'll advise you. That may be something that you have a conversation with the investor. May not be something that rises to a materiality level where it needs to be disclosed on the disclosure schedule. But there might be some other areas where, for example, you had an employee that left. They claimed that they didn't get paid their last paycheck properly, and the amount that they weren't paid was, I don't know, $5,000 or $6,000. Maybe not a big deal. Using the perspective of a $10 million finance, you might look at that and say, come on, $5,000, peanuts. But the important thing there is that may be only one potential claim that employee might have. If they're disgruntled and they left, and they can create a whole bunch of other claims, and as long as they've got some sort of basis to file an action, it may not be just the $5,000 or $6,000. They may file a lawsuit saying, yeah, I was harassed, and you guys terminated me because I complained you weren't doing something properly. Now you're talking about a potentially much larger litigation, and just the defense of that alone could be several hundreds of thousands of dollars. And if they're accurate and they weren't treated properly and you violated certain laws, then the potential exposure could be even higher. So the point being is those assessments really need a trained eye and someone that's got a lot of experience about thinking through that process. That's where you team up with your lawyer to make sure you give them all the information, and then your lawyers will make sure they understand what needs to, and advise you on what needs to be disclosed and what doesn't need to be disclosed. Okay. Yeah, just a quick reminder that the link to the recording and to the slides will be made available. Give us a couple of days, but yeah, if you missed any part of this, you can definitely go back and see it. So we're at the 10 o'clock mark. I know I try to reserve about half an hour or so for questions. I'm just going to cover a couple more points and then we'll open it up for some more questions. Getting investment ready. This is sort of a summary of what we talked about before, so I'm not going to go through it in too much detail other than just to say, you just make sure you're really prepared. The more prepared you are, the easier, the less delays, the less costly it will be, and the better relationship you'll start building with your investor. Make that whole process as clean and easy as you can. And the big ticket item for startups is, since they're all typically budget conscious, is the more of that stuff you can take care of and be prepared for, believe me, the less expensive it will be on the legal fees. Because if we have to come in and clean up a bunch of stuff, it can get very expensive very quickly. So the more of that you do right from the beginning, and it's there, it's easy, it's organized, the less time it'll take, and consequently, the less you'll have to pay on legal fees. I didn't talk too much about data rooms, but I always recommend, get a data room set up well before even a financing. I mean, make sure you obviously do your research and get a good data room that's got a good reputation, it uses the proper protections for data security and privacy, but organizing it early on is going to be super helpful. Come up with a naming convention so you name your documents in a way that it's easy to understand what it is. There are ways to do that. Happy to talk to people, offline about that, but to make it as easy as possible. So even when your internal team's looking for stuff, it's easy to find. It'll also be easy for the investors and your lawyers to find. All the way around, it makes it a much better experience. I think everything else I've kind of covered. So let me talk about. Always be closing, again, doing your homework, getting prepared. I know I keep repeating myself over and over, but I can't tell you how many times this doesn't happen and the client's not happy with the bill because they didn't realize there was all this mess to clean up and they wanted us to clean it up, and it took a lot more time. So just understand that this all plays into the whole overall financing process. So some common pitfalls, and then I'll take any questions that people have. There's a few I'll go through. So not setting up the entity properly. If you don't set it up as a Delaware C Corp and you get an investor, they may say, great, love the company, want to invest, but you first need to convert to a Delaware Corp. So it can be done, but oftentimes some delays, more cost. Try to avoid that if you can. Not having proper documentation can create major issues. I think I gave you a couple of examples. The founder walking away, developing technology, but no agreement to assign for the company. Not having the proper vesting. I've seen this come up a number of times where there was no vesting, there was no repurchase right for the founder shares. Founder left after, one of the founders left after a few months with 30% of the company, and the company had no recourse, no way to get back that 30%. So now you've got some guy or lady that basically has left the company, not participating. but they have 30% of the company, which is huge. Investors don't like that. Undocumented stakes, you've told someone they've got a percentage in the company or they've got certain number of shares, you never documented it properly, you forgot about it, and then there was a financing and that person suddenly showed up and said, oh, I heard you're raising 10 million bucks. Great, you gave me 5% of the company, remember? Now you got to deal with that. That becomes a big problem. Not complying with securities laws, not filing your exemptions, not managing the cap table. Side letters that you forgot about that have, for example, as I mentioned, that particular early investors got a right to purchase a higher amount of the next round than is normal, or that you can't do another round until you get their permission or their sign off. Very unlikely, but I've seen it. So those are oftentimes some of the common pitfalls. Not handling employment-related issues properly, not being compliant, not making sure you've got a good tax advisor. That I've seen create some issues as well. Okay, so let's talk about some questions. I'm sorry, I'm looking over here because I'm looking at the questions right here. So, okay, so how does a solo founder get just compensation for IP? They have 2 patents they want to bring to a new corp. If the company fails for any reason, investors could potentially take the inventor to an inventor. Should the IP be licensed to the company by the inventor until the founders' shares are vested? That's a great question. So, you have to always manage the tension point between, what sort of economic rights someone's going to have versus what sort of control rights, especially when you're talking about founders. And so if you've got a couple of founders and one person's going to contribute IP, generally speaking, if you want to, at some point, go out and raise financing, the investors are going to want the IP to be owned by the company. They're not going to like the fact that, yeah, I'm going to put in 10 million bucks and wait, you're telling me you don't own the IP that is worth and driving the business? No, that doesn't work for me. If one of the founders has it, they're going to say, great, founder, you assign the IP to the company because I'm not going to invest in a company that doesn't have anything. It's got to have value. But I see the point, and the question is, well, how does one of the co-founders protect themselves if they've developed it and they've got the patents and now they're contributing to a company and they're only getting 50%? How do they protect themselves if the company doesn't work or whatever reason the other co-founder doesn't work out, et cetera? You could do a license to the company initially at some point, then it's going to have to be transferred. The ownership will need to be transferred in order for investors to come into it. So you have to make sure you plan that properly. It gets complicated, and there might be some tax consequences depending on when you do it. You could have a shareholders agreement between the 2 co-founders. So you've got an agreement, a contractual agreement that says, look, I'm contributing the IP, I'm getting X% of the stock in the company. And there's a whole bunch of other provisions you can include in a shareholders agreement, including, hey, if you, the non-IP participating co-founder, walks away, doesn't want to be involved, then you've got to sell your share of the company, or the company can buy the shares. Or for some reason, I get booted out of the company, not because I did anything wrong, but because you took advantage of me or something, then I get the IP transferred back. I mean, that's a really complicated question. I'm happy to talk with you offline about it, but there are ways to try to protect against that. But bottom line is, licensing is a good idea, but ultimately for investors, it's not going to work. Okay, so let's talk about the vesting. Someone had a very, very specific vesting and dilution issue. I'll reach out to me privately if you don't mind, and we can talk about that. Explain options. So purchase rights or exercise price at a cent a share. How do they convert? So going back to what I mentioned earlier, so an option is a right to purchase shares in the company at a future date. So on the day so the way it works is the company says, all right, John, you joined the company as an employee, we're going to pay you whatever salary, and we're going to give you an option for 100 shares. And the 100 shares will be at a penny a share. So you get a piece of paper that says, I've got an option, I've got a right to purchase 100 shares once those shares are vested, and they vest over time. So I, Johnny, need to put in my time with the company before the options vest, and I can purchase them. And the typical 4-year period with the 1-year cliff I mentioned means I need to put in a whole year's worth of work. After 1 year of working with the company, 25% will vest typically. So I could then, after that first year, buy 25 shares at a penny a share. And then monthly thereafter, for the rest of that 4-year period, they will vest equally over that 3-year period, remaining 3-year period on a monthly basis. So as each month ends, as I've completed another month of service, I'll get more shares that'll vest, option shares that'll vest, and I can buy more shares. So at the end of the 4th year, 100%, 100 shares will have vested. I can pay a penny a share and buy the full 100 shares of the company. So it's conversion is not the right word. There's no conversion there. You're buying. It's a convertible security because it's a security that gives you a right to purchase shares in the future. So you've got a right now. I guess you could think of it, that right to purchase converts into an actual purchase at some point. But the better way of looking at that is to say it's a right to buy shares in the future. It's called a convertible security. Maybe a little bit confusing, but that's how the option works. Okay, I have an S Corp, been active for 10 years, used for consulting. It's a good idea to brand a new Delaware C Corp, or is there some value in converting the S into a Delaware C Corp? Well, this all depends. It's a specific question, but generally speaking, what I'll say is if you've got an existing business, you've been running for a while, it's successful, it's doing what you want it to do, no need to change it. If it's an S Corp and that's the way it's been operating, keep it as an S Corp. But if you're going to change and do something where now you're going to go out and get other people to invest in your company, i.e. third-party investors, and those investors may be sophisticated investors like VCs, they're not going to like the S Corp, which is a pass-through. They're going to say, great, we love you, we want to work with you, we'll invest in you, but we're not going to invest in an S Corp. We want you to convert to a C Corp. Or if you can, depending on the technology and all that, you know, how much you've developed, you could potentially create a new company, as you mentioned, as a C Corp and transfer the assets to the C Corp. It gets a little bit complicated because if you want to keep your existing consulting business, which I've seen people do on occasion, but you're developing something new that has value, that may be an instance where you may consider separating it out. So you keep the consulting business, which the person's going to keep doing and generating revenue. Maybe that's what puts food on the table. But now you've got this new concept that you're building out, which really isn't consulting. It's going to be, let's say, a subscription-based software business model, different. So that would be maybe appropriate to set up as a new company. That's the one you're going to go get investment for. That's the one that gets set up as a C Corp. Great question. How does location of data room matter, considering financial constraints? For example, Intralinks is costly. Do you see early stage founders use Google Drive or Dropbox? What do you recommend? Well, I'm not going to make a recommendation for a particular provider. You need to go and kind of research that. But I'll tell you, there are definitely cost-effective data rooms that are available. And, you know, there is the typical Dropbox or Box that everyone knows that are, you know, they're pretty large companies now. They've been around for a long time. I think if you go and look at their websites or talk to them, they'll give you all the information about what they use to make sure your data is secure and private and all of that, which you want to do. The more sophisticated data rooms are very expensive. In some cases, they can be thousands of dollars a month. You don't want to spend that kind of money, at least not at this stage. When you get to a much more mature stage, yeah, you may want to do that for a particular financing or a particular transaction, but only when you're generating enough to make it worthwhile to pay for that. Because they can get very expensive very quickly. But I've certainly seen companies use Box. I've seen companies use Dropbox. You know, the one thing that some law firms do, we do that for our clients. When we have a new client, we oftentimes will set up a data room. We manage it, we host it. We don't charge anything extra for that. But we use a program and a technology that we can create a data room. You can upload documents to it. It's also a data room that we've been able to use effectively on transactions too, because we can open up the data room to investors and their counsel. So some law firms do that. We're one of those firms, but that's another resource as well. But they're definitely very cost-effective resources used. And Google Drive is another option as well. I know some people like Google Drive and Google Documents, some don't. So try to choose the one that's the easiest to navigate and use. I think you'll be better off that way. Okay, so Please elaborate on anti-dilution protection for the founders. What clauses can founders include in equity financing agreements to prevent dilution beyond a given percentage, and why would investors agree to that? Great question. So, generally speaking, what I'll say is you're doing a VC style financing in the documents. It'll be in the certificate of incorporation, where you'll have typically the anti-dilution provisions. And that's oftentimes intended to protect the investors, so that if an investor comes in and invests money at $1 a share, and then you later on decide in 6 months or some other time after they've invested that you're going to go out and sell more shares, but you're going to sell at a lower price than they invested, that is where typically there'll be an anti-dilution protection that can kick in and say, wait a minute, we invested at $1 a share. You're now going to go out and sell shares at 50 cents. You've essentially devalued our investment. So we're going to now have a right to purchase shares, or, it depends. There's different types of anti-dilution. There's full ratchet, there's broad-based weighted average. I'm not going to go into too much detail on that, other than to say those are all designed to protect the investors, so that there's a mechanism and an equation that gets used to calculate out what will happen to their investment in the shares that they purchased, so that they don't lose out on the situation where now you've gone and sold stock at a much lower price and devalued their price, what they've invested on. With regard to founders, dilution is sort of, part of being a founder and raising financing from other parties. It's going to happen. You can invest alongside. I've seen investors also invest, founders also invest as part of the financing. There's nothing that prevents a founder from also participating in buying Series A stock or Series C or whatever the case may be, if they've got the funds. You can negotiate on the anti-dilution. You can negotiate on, a number of the provisions in the documents to try to give the company, and i.e. the founders, a little bit more protection. How you negotiate sometimes the pre-money valuation, how you negotiate on, the different rights that the investors are going to be getting, that can help you indirectly on dilution. So there are some protections and things that you can do. There's probably a bunch of different ways to approach it, but I'm pausing because I'm trying to think of whether I've ever seen a scenario where I have seen some scenarios where the founders had built into their documents and their rights the ability, for example, pro rata rights to be able to buy and keep their percentage at a certain level. Sometimes investors don't like that. So that can be a conversation and potentially a negotiation when you get to that point with an investor. But that could be one mechanism. The ultimate control is the founder doesn't have to sell to that investor if the terms are not what the founder likes, or they can get good counsel and with good counsel negotiate the best terms so that you minimize some of that dilution. You can have, as part of the financing, sort of a top up and top up on the options that the founder's gotten or the stock the founder's gotten. So giving the founders some additional shares as part of the financing, or giving the founders an option that's a part of the financing that allows them to be able to purchase more shares to increase their percentage in the company. So kind of like a pro rata right in a sense, but it's given to them a little differently. So I've seen that used as a mechanism to give the founders a way to minimize or mitigate against the dilution that's going to happen when they go out and raise financing. There's probably a number of others I'm not thinking of at the moment, but those are some of the different ways I've seen founders try to protect their ownership interest in the company, or at least to minimize or mitigate the dilution that they will suffer as they go out and raise financing. The last part of that question was, would investors agree to that? It depends on what mechanism you use. So, for example, I've certainly seen scenarios where you do a financing, founders want to get some additional options to buy more stock in the company, or they're going to get some additional shares issued to them as part of the financing. I've seen that, and I've seen investors be okay with that. It depends on the percentage and the amount. But I've certainly seen that as something investors have agreed to, depending on the specific facts. But yes, that's one thing I've seen investors agreeing to. One person said, yeah, just reach out to me with my email's there on the screen. Feel free to drop me an email if need be. We can set up a call, talk about anything specific. Next question, how to protect the founder's patent rights and secure investment. So if I understand the question, if you're a founder and you've got patent rights, you invented something. So if you've invented it and you own the patent, as I mentioned earlier, if you want to get investment from an investor, they're typically going to want the patent to be transferred over to the company. So the company they're investing in owns the patent. So again, and I think I answered part of that in an earlier question about, well, how does a founder protect themselves if the company doesn't work out? That can be put into an agreement so that if the company dissolves or if the company doesn't raise financing, or if there's a dispute with the co-founders or what have you, that they have the right to get that patent back. That's going to have to be negotiated and agreed upon if there's more than one founder. If there's just one founder and the company doesn't succeed and you're going to wind up and liquidate the company, you got to make sure you pay all your liabilities. But assuming there aren't a lot of liabilities there, the rest of everything that's left, including the patents, you could distribute back to yourself once you wind up the company. That's a complicated process. You need an attorney to handle that piece of it, but that's one way you could get it back if things don't work out for the company. But I think the short answer is to raise the financing, investors are going to want what's valuable for the company to be owned by the company. Do angel or seed investors typically also use the NVCA forms? Yes, I've certainly seen them use the NVCA forms. The one caveat will be it depends on the sophistication of the angel, the seed investor. You've heard the term, I'm sure, family and friends. So if you form a company and you've got a great friend you've known since childhood that's got a ton of money and they want to invest, you may not use the NVCA forms. Those forms, it requires a lot of work. It's going to involve more expense. They may want to use a convertible note. They may want to use a safe investment. And, that could be in a situation where you may also use the Series C forms if they really want to buy stock. Or it could be, every law firm has their own proprietary forms too, typically. If you're not using the NVCA form, then the lawyer you're using could come up with a set of forms, and maybe it's sort of a watered-down version or a much trimmed-down version of the NVCA forms or the Series C forms that is appropriate for maybe a single family and friends type investor where there's a close relationship between the company or the founder and the investor. But yeah, I've certainly seen angel investors and seed investors use NVCA forms. And the reason why that is because they are so well known and they're used so pervasively throughout the financings that occur, is there's comfort because the investors know the forms. Typically, a lot of the founders that have done multiple companies and have used them know them. So there's comfort built into them. They're well vetted, so they've been reviewed by multiple credible law firms, by multiple very well-heeled, very sophisticated investors and VC firms. So there's comfort in knowing that the forms you're using are really well drafted and represent market terms. So that may be another reason why an angel investor or seed investor, especially if they're more sophisticated, may want to use the NVCA forms. Okay. We've got a few minutes left. How do you justify sweat equity to investors in a new round in the early years? An example, where you are seeking a high valuation, have not invested much actual cash, but have spent, say, 2 years building a startup. That's a great question. And that is a question that is part of sort of building your slide deck, being able to demonstrate what you've done. And oftentimes that's a conversation that you'll have with the investor, but investors get it. I mean, they're not necessarily saying you have to bootstrap and you have to put your own money in and you have to fund it yourself. I will say, though, investors like that because it means you've got skin in the game. So you've got money to lose as well. And that puts you at least on a more of the same playing field as the investor because they're putting in cash, hoping that's going to, do well and they'll get a return on their investment. And if you've also put in some of your own money, then you're basically in the same scenario where you've also risked and rolled the die on this investment as well. But having said that, yeah, there's a lot of companies that they put in a minimal amount to get things going. They form the company, so they pay for that. They pay for a few other things. but they don't have the money to build a prototype or do anything or do the coding for the software or whatever the case may be. And yet, let's say they are a coder or they're the tech guys or tech person, so they can build the technology, and they spend 7 hours, 10 hours, 12 hours, weekends, weeknights. The investors, once they get to know you and you sort of tell them the story, they'll understand that and appreciate that, and they'll certainly give you a lot of value for that. So there's no one right way to answer that other than if you don't have the cash and you're forthright and transparent with them, but you can show them that you've spent the last 2 years developing it, they'll get it and they'll respect it, and oftentimes we'll give you credit for that. Okay, I'm not seeing any other questions. Let me see if there are any questions in the Q&A. I don't. Okay, yes, there are some questions in the Q&A. So for options, when is the tax due? What's the basis to calculate the capital gain? These are questions I don't have time to go into. Reach out to me separately. There are certain tax considerations to be aware of with options. So definitely, if you're on the company side, you need to comply with the requirements. There are different types of options. There's ISOs and non-qualified stock options. The tax treatment is different. So as a company issuing or granting options, you need to be aware of that. Typically ISOs only go to employees, can't go to entities. So you just need to make sure you manage that piece of it properly. If you're on the other side getting options, then you should have a conversation probably with your tax advisor. But, on the lawyer side, we can do that as well. We usually work with one of our tax exempt or our exec comp specialists that handles that. They're usually part of our tax group, but it can get a little bit complicated. But happy to talk to you offline. Calculating capital gains, so those are questions better for a tax, really primarily an accountant that would do your taxes to account for that, or with one of our tax folks. So reach out to me separately. I have an S corp. That same question. Slides will be and recording will be available. I think I've covered the Q&A and the chats. Let me take another quick look. On a pre-revenue basis, how do you value a company? Great question. Yes, if you don't have any revenues, if you can spend the time and look at other companies, and sometimes there's data out there, sometimes there isn't really good data, but if you kind of look and see what other companies are doing, if they're in a similar space, if they have announced any sort of financing, sometimes that can be a basis to look at, okay, well, there's another company that's similar. They just did a Series A. Their pre-money valuation was 10 million. I know the company, I know what they do, and yeah, maybe they're further along than I am, or maybe they're not quite as far along as I am. Those are all good data points in using. I mean, ultimately, there's going to be some art, some science, and some guesswork as far as what valuation you come up with. Some of it will be driven by the market, and as I know it's probably seen over the last year, the market's sort of taken a downward turn to a certain extent. So valuations have typically been down, not getting the same valuations that we were back in, let's say, 2021 or some of the earlier years. And so that gets factored into that as well. And then sometimes there'll be a discussion and a little bit of negotiation between the company and the investor. And one thing I'll say there is, if you're going to question or try to negotiate the value with an investor you're interested in, you need to be really careful, because you want to do it in a way that's respectful, but you also need to be able, and you may have a great point, and you have great support for your evaluation. Just make sure you're prepared to articulate that, because you need to be able to explain to them, yes, I hear what you're saying, but here's everything I've done to come up with the value. And if you've done a really good job and you've done your homework and you've done your research and you've got a really supportable position, you could potentially negotiate that and maybe have a higher valuation than what the investor is initially saying or thinking that the company may be worth. So it's a little bit of a fluid scenario. Okay, we are at almost 10:30. It's been an hour and a half. I know I've taken a lot of your time. Hopefully you got a lot out of this. It's always a pleasure talking to everyone. Wish you all the best on your ventures. Landfo is up on the screen here. Feel free to reach out. I do encourage you to check out our Fully Ignite site. I know we dropped the link in there a little bit earlier. Maybe we could drop it in again just so it's down towards the last part of the chat. But essentially, it's a great resource for all of you, whether you're a founder, entrepreneur, whether you're in the management team, or even on the investor side. We publish regular articles on all sorts of topics, but definitely topics that are of interest to the startup ecosystem. And it can include everything from sort of early stage stuff all the way through later stage M&A type stuff as well. But hopefully you got some good tips out of this, and look forward to my next one. I'll probably do another one next month on a slightly different topic. So thank you all for participating, and wish you all a wonderful day or evening. Thank you.